Hello, everybody, and welcome back to the Discovering Commercial Real Estate podcast. I'm your host, Michael Tingez. With us today is prominent community leader and the key leader at Ponce Bank, Doug Romero. Ponce Bank focuses on stabilized financing, but has a real expertise and is taking over on construction financing. They're the go-to lender in the boroughs. Doug, pleasure having you with us.
Thank you, Mike.
So before we jump into the business portion, tell us a little bit about yourself and how you got into banking.
A little bit of a long story. So, born and raised in Queens, started in banking. I landed an internship when I was in high school. This was back in 2003. Started in the mailroom. Worked for a small community bank, Latino based out of Manhattan. Uh, Great institution, good times, and essentially started in the mailroom. Eventually got into credit underwriting as I secured a full-time job. Uh, and I was going to school at night, full-time school. I was going to Baruch at the time, and fell into credit underwriting. So back then, did a lot of affordable housing construction. And if you've done construction with the city of New York, it's basically no pulling punches. You need to have all your ducks in a row: your subcontractor agreements, your GC agreements, performance bonds, 10% letters of credit, all these things. And this was the school that I came from, and I've always carried it with me throughout my career. I later come to discover that some of this stuff sounds good, is good for purposes of underwriting. However, for practicality purposes, maybe not the most practical of items. It's just more window dressing than anything else. But that's where I developed the passion for construction finance. I sort of fell into it and found myself to be very talented in it, and I saw the impact. I saw the impact. I saw the families benefiting. I saw the improvements to the neighborhood, and I was very proud and felt very blessed to be part of that whole initiative.
Awesome. So from 2015 to now, how has the construction landscape changed in New York?
From 2015 till now, it's changed a little bit. So I've seen a lot of progression with a lot of moments of a few moments of uncertainty. So, for example, we went from a situation where we had post GFC, right, Great Financial Crisis, where we had historically low interest rates. Interest rates crept up, so we had to deal with that. They stood low, so that spurred a lot of construction. Plus, we had tax abatements, the original 421A program. Then tax abatement expired, so then we had the Affordable New York tax abatement that kicked in. Then we were doing okay during that run. Then 2019, the rent stabilization law changed. That had an impact on real estate for the stabilized housing stock, which put a little bit more pressure on new construction and new developments. And then the pandemic, right? Yeah, the pandemic,
Yeah.
2020. That was a fun time. We had a lot to navigate through in terms of supply chain disruptions and capital needs. But we weathered the storm there, and then interest rates started to uptick a bit. And now interest rates are still, I would say, a little high. Um, but yeah, we've seen a few up and downs. In general, high level, what we've managed to see is just general progression. Neighborhoods have changed, and I want to say changed for the positive. Uh, Building a lot of nice new housing, and it's across the city, from the upper luxury stuff to the middle market stuff to the affordable housing, lower income working class AMI stuff. We've seen it all, and I think you can see it in the neighborhoods, like downtown Brooklyn, amazing what's happened out there. Long Island City, amazing. Flushing, Queens, amazing. Even East New York, right? If you go to Atlantic Avenue, you have a lot of nice new affordable housing, huge structures. It's doing really well. Um, so it's across the spectrum.
And you mentioned COVID. So during COVID, I assume that you guys had a lot of construction projects going on. How did developers kind of handle the stoppage of supply chains and everything?
So it was on a case by case. It did come to light very substantially. A lot of material and building material was being sourced abroad, being sourced, from Asia predominantly. And we had to sit down, and so at Ponce Bank we're very open and open in communication. We're very accessible to each other. So, in running with the construction lending program and knowing how sensitive things are and our ability to adjust and adapt on the fly, that was pivotal. That was huge. We were able to sit down, call meetings. We were noticing a trend where suppliers were saying, we understand we gave a deposit schedule. If you're familiar with the deposit schedule, it's like part of your subcontract. Essentially, you identify payment markers. And as long as you keep up with the schedule, we can work and deliver. COVID was a disruptor. COVID came in, and all of a sudden you saw tightening up in credit. And aside from the tightening up, you also see the containers. You couldn't even get containers. The shipping costs went through the roof. Uh, Things were getting held up, with at the freight at the ports. Um, so we started seeing accelerated deposit schedules. We had customers calling up certain suppliers demanding, saying, "Listen, for me to source your material for your job, I need to accelerate this deposit schedule. Otherwise, I have to go to someone else who's willing to secure that allocation." So that put pressure on the banks because it put pressure on the borrowers. And we would have to sit down with the borrowers one by one and say, okay, re-ascertain their financial wherewithal to then see, all right, how are we going to carve this up? Because the bank's not going to take the whole risk of just, okay, great, you guys want to pick up an extra deposit. We're just not going to pay like that. Doesn't work that way. So it was a situation where we had to ascertain the whole thing, ascertain how much the individual borrower could contribute, how much the bank could contribute, and work it out that way to still secure the material and still secure it timely. So that was a little involved, but we got that done.
So you guys are always there for your borrowers.
You have to be. You have to be. If you're not there for your borrowers, then essentially you're not there for yourself. Because if the borrower has issues, the bank's going to have issues. And that's not our business. We have to be sensitive. We have to be understanding and agile enough to move with the hardships. And again, I'm that type of mind. I'm that personality that, you know, yes, it's easy to look at things on a macro level and on a spreadsheet. Okay, this worked, this didn't work. I need everyone to work. I need every cylinder to run. If every cylinder's firing, you got a well-oiled machine, you got a beautiful engine, everything's going. Um, so we'll take the time on an individual borrower basis and just to make sure everybody's pushing, everybody's moving. And that's part of our portfolio management process. Every month, we expect monthly requisitions. If we don't get a requisition, that automatically becomes a bit of a flag. Okay, well, what happened that if you're not asking for funds, I'm assuming you're not moving. And that's something to always look into.
And for the viewers listening, what is different from construction financing to permanent financing is construction loans aren't paid off at once. And that's why having a lending partner is so important. Once you close on the loan, as Doug mentioned, requisitions are something that's paid out per request. So if you do your foundation, you call Doug for requisition and they fund you. So Doug, post closing, how important is it to be step by step with the borrower in the construction process opposed to permanent financing?
That's everything. That's everything. So I guess distinguish the two on a construction loan, it's constant proactive monitoring. We're on a first name basis with our borrowers essentially every month because every month the expectation is you're requesting funds. On a permanent loan, as long as you keep up with the payment, uh, at most, what any normal or regular, credit review process would entail is the requirement of annual financial statements. Submit your annual financials, tax return, income and expense, these things. Um, And then as long as you have good payment performance, that's it. I don't think you're going to hear much more from the bank. On the construction side, every draw is a conversation. Every draw. So we would schedule a requisition with the bank's construction consultant, essentially an engineer. They'd go out, visit the site. You would have these standard, industry documents like the G702. They're AIA forms. The American Institute of Architects were wonderful enough to put a very uniform form together. And that's what's generally used for requisition purposes, where you itemize every trade and you have a mechanism for every month to track each draw. Okay, so if the trade is 100,000, draw number one's 10,000, our engineer would go verify draw number one. Okay, is there $10,000 worth of work? And you would get, copies of invoices and whatever pertinent backup you would require on that front. Once we get the requisition and the engineer's recommendation, we then proceed to go through our process to then fund. And we want to ensure timely and healthy funding every month because we need you to move every month. If you're not moving, it could cause delays. Delays turn into other conversations and sometimes can get a bit adversarial. We don't like extensions or fees. Personally, I don't like it. Yeah, sure, the banks generate income, and that's important. But I think there's better ways to generate income. I'd rather turn over a deal than to start, charging fees all over the place.
And as a lender, right, every time you get a new deal, there's the borrower vertical and there's the actual deal. So how much emphasis do you put on the borrower opposed to the actual project itself?
In today's world, I'd say it's 50-50. I've had deals where it's a fantastic location. I want to do it, but the borrower is not there in terms of qualifications and capacity. So you have to let it go. As much as it hurts, because I get stuck on the real estate. That's me. But if the developer behind it, if the sponsor behind it is not there and doesn't demonstrate that capacity, that's just as important. Meanwhile, look at the other way. You have someone who's super strong, super experienced, and maybe the location is, and I don't want to say there's any bad location. There's good. It's New York City. It's the greatest city on earth, across the board, across all neighborhoods. But let's just say you have a more experienced developer who sometimes might be a little more aggressive in certain submarkets than you would essentially want to be or you feel comfortable with because you don't have the market data to support it. And sometimes you have to have that conversation with developers. Like, I know you can do it. I know you can carry this. You're just a little optimistic. If we can adjust a little bit, essentially adjusting means lowering the loan amount. I think we'd feel safer. You have financing and we can go. It requires more equity on your side. But if you're okay with it and you believe in your project, which we hope you do, no problem. And sometimes we run into that situation. The worst situation is when you have someone who's completely not experienced and they just can't put it together. And I've had that. I've had that happen where a developer would come in and just essentially taken for a ride. It is a delicate balance. You do need tough skin in the development world and in the financing world. Otherwise, people will bully you into paying out when you shouldn't, and you run into project inefficiencies, and that's a problem.
What makes a qualified borrower?
So it's a combination of, actual trench experience. Have you built A through Z, right? That's huge. But then it's also your character, right? That factors in. And people have, varied moral compasses. Some guys, their paperwork is neat all the time. Other guys, they're a lot more flexible, a lot more aloof with the paperwork, with the backup. Oh, but why do you need that? It's not important. You don't trust me. I trust you. I trust you more if you give me the paperwork. Because at the end of the day, I'm a regulated institution. really not debating here. It's you want to get funded, I want to fund, I need what I need. Um, so it varies. It varies. We've been very blessed. I've been very blessed to the extent that, we're good at weeding out and we know our risk appetites and the type of profiles. Like we almost got it down to an art form. The people that we work with, the communities that we serve, the projects that we engage, the economics behind every submarket, and it's all relative. Anytime you build, you're building new housing, and you just have to make sure that whatever product you build, number one, it's safe, secure, well built. uh you capitalize all your costs and identify your sources, whether it's going to be 60% of the cost is from the bank, 40% is coming from the borrower. You want to make sure the borrower infuses his portion first. It's only fair, right? If it's your project and you believe in it, you have no issue putting in your funds day one or over the course before I kick in, right? You're committed. I'm committed with you. We get it built. And then now the last part would be the stabilization or the sellout. Um, you know, is this fitting for the area? Can the area absorb this? Who is my end user? That's important. You need a solid, or otherwise you don't really have an exit strategy. You can't just generically say we'll get refinanced. Okay, that's great, but you have to stabilize to refinance. That's actually been more challenging today. Uh, Interest rates have not come down, and we have a lot of finishing construction where the pro forma rates when we first started the underwriting is still substantially higher than what was initially projected. Right? If we did some pro forma underwrites at, I'd call it 5.75, 6%, and you're half to a point over these days, and that has an impact on the economics of the deal. Now you're not as easily refinanceable, meaning a layer of your refinancing options are not there, essentially banks. What you'll see is the more aggressive lenders, and is why you're seeing a lot of traction with the private debt funds and the hard money space. They're picking things up because they can be a little more aggressive. They don't mind it, but they also charge for it. And that puts the developer in a predicament. It's not ideal. Their debt service is a lot higher. It puts a squeeze on them and their building. But they also transition out of a construction loan. And so they're good with the bank.
Yeah, and
It's not easy.
what Doug's talking about when he talks about when they underwrote projects, whenever a bank is looking at a construction project, they always look at it as a rental. So when they were underwriting the pro forma to hit a 1.25 debt service coverage ratio, they were underwriting at 6%. Rates are not at 6%. So when you increase the rate, your debt service takes a hit, and it makes the borrower have a problem getting taken out of construction loans, because construction loans aren't, they're intermediate, they're 12, 24 months. And have you seen a lot of problems, borrowers having to cash in equity to leave the loans now?
Uh, Not necessarily. Not. I've seen an uptick in mezzanine financing or financing. Essentially, a secondary lender would come in and take uh take a little bit of risk on that middle ground, that delta where the bank is not willing to go further and the borrower doesn't want to stretch that far in terms of their cash position. Um I've seen a little bit more of that. Right now in today's world, I've seen a slowdown in construction applications. The only developers that are really putting in applications are those that still have a strong base for sourcing or raising liquidity, whether it's themselves or maybe taking on a partner and kind of pulling together for a bigger project. That's how I've seen construction loans happening right now. The smaller guy virtually disappeared.
And as such a leader in the community, and Ponce Bank is the go-to construction bank in New York, what's kind of in the strike zone for you guys right now? What are you lending on? What's the appetite?
We see all types. We see all types. So a $2 million construction loan requires the same love and attention that A $70 million deal requires. $100 million deal requires. I would even say the 100 million and at that level, because it requires, sometimes participants and other partner banks. Those are even harder to put together. Like you drag out forever and maybe it works out. I would say our sweet spot's 20-30. Like we like that space. In New York, in middle market, 20-30 is not that big of an amount. So we have to entertain bigger, for some of the A developers. But we're open. 20-30 we're happy with. Anything more we'll look at. Obviously this is what we do. But that's our comfort zone.
Can you walk us through a deal that you closed recently that, made an impact on you or was specifically challenging?
I just did one that I lost sleep over. It was complicated. It was more complicated than I wanted it to be. So it was a deal that essentially was a 5 building assemblage for a particular developer, super reputable, super builder, just tremendous group. So he had financing in place with a hard money lender, a very reputable hard money lender, who said, I can come in and I can do all of it. And we're talking hundreds of millions. No problem. Somewhere in between, and I can't complain about this because it benefited us in the end. The idea said, well, we can organize a group of banks to come in and handle this financing. And you're going to save, right? Because a couple interest percentage points on a few hundred million is a lot of money.
Yeah.
So you can't be mad at that. And a few banks, we all got together to essentially take out the existing land loan and take on the construction. But it's one of those situations where we're all separate institutions and, left arm doesn't know what right arm's doing and everybody's running on their own track and you have personalities in between. And actually, in this case, I do want to shout out our attorney. I felt it. And I don't know if anybody would disagree, but he jumped on a conference call and he just lined everybody up. All the bank attorneys with the banks behind them said, guys, this is the action plan and this is where we need to go. And he really brought it home to get us all on the same page. So what we had to do, because it was one private debt fund who had essentially a mortgage on all the land and he wasn't doing any releases, we had to close simultaneously. It was 3 banks to take out the land loan and to coordinate this during holidays. Not happening, but we did it. And then the second part to that was to close on the construction. It was daunting. It was really daunting, but we got it done. We were able to all pull together. And in addition to just us, closing on the transactions, we also managed to secure participants on it too, because we took 2. So it's 5 buildings. We're doing 2. And we have 2 wonderful participant banks that jumped in with us. They saw the value. They wanted in on the deal. They're like, oh, we'll work with you. And we're very grateful and appreciative for that. But again, to coordinate and do all this it was really hard. And then, so actually this was the craziest part. So everybody's moving on separate tracks. We took care of the land. We're getting ready to close on construction. One bank already closed on their construction. Another bank was getting ready to close on the construction. The construction of the SOE, supportive excavation, was already underway and essentially done. The foundation was essentially done. So now he has to build the buildings. One of the buildings that we were financing, because the way he put this together, he got this done in a way where 4 buildings were essentially market rate and all the inclusionary housing, all the affordability of it was put on one individual building, which happened to be my building. Or the building that the bank's financing. I take it very personally.
Yes.
It's the one that we were doing. So now we're in the midst of all this, and we get a phone call. I got the call. It's like, Doug, I have 900 workers ready to deploy on Monday. I need to close on this inclusionary housing with HPD, because you need HPD to close with us to ensure that all the underlying land disposition agreements and everything's in place. I need to close on this building. I was like, okay. I need to close on Thursday, and I got the call like on a Monday. We're essentially ready to go, but we still wanted to line up participants and all this stuff. We thought we had time.
Yeah.
All of a sudden, we don't have time. And not only do we not have time, but if we don't get it done for this building, now we're holding up all the other banks, because he cannot do his construction unless he closed on the affordable component first, right? The city has to make sure, because once he has that locked in, he can then go to DOB and secure the permits for essentially the new building, the rest of the project. So that puts us in a spot. And I literally, first phone call, my dear chairman of the bank, president of the bank, chief lending officer, I was like, gentlemen, we have a problem. We sit down, we have a meeting, we weigh it out, green light. We call everybody. We said, we need to hit this deadline. Let's get it done. We closed. After we closed, everything else fell together. Now the project's flying. And that is the type of lending, that is a real trench story that, when you have to move, you have to move. When you have to be there for not only the developer, but for the good of the project and in consideration of all the partners involved, these are the things that need to happen. And it's hard to coordinate when you have different players. Honestly, and I've discussed this with the developer, it may not have been an issue had he just had one lender, but that wasn't the case here. And, we were there, and I'm thankful we got it done. So that was a deal that I lost a little sleep over. But
So being a lender in construction, every day is meaningful. Every day that's delayed is super important. So you moved on your feet in that transaction. Does that happen a lot where spontaneous things happen and you just have to react?
all the time, all the time, all the time. Sometimes ownership and uh doesn't have the best relationships with their subcontractors, you know, and the bank has to. So our fiduciary responsibility is always to ownership, but sometimes they have, and they're in situations, because it's not easy to just replace subs, especially when they're on record. That's a delay. But in the midst of battle, and when you get to certain points, one may try to take advantage of the other and say, "Hey, listen, I'm not gonna finish this unless you pay me." And the other guy say, "Well, I'll pay you. Just do the work. I don't trust you. You're slow."
Well,
Things like that come up, and sometimes the bank has to find themselves the mediator. Obviously, I'm bound to my contract with ownership and the borrower, but I also have to be there to reassure. It's like, guys, this is all spelled out. If you work, we pay. That's it. It's not, doesn't have to be adversarial. But so we don't have construction problems, and I say this all the time. We don't have construction problems. We just have people problems. The process is the process. You do what you're supposed to do, no issues. Problems arise because of the different personalities and the egos and the disagreements and the shouting, and that's no good.
so relationships are so important, right? Either with borrowers or bankers or mortgage brokers. In such a transactional business, how do you maintain those relationships with clients who are not currently taking a loan?
Like you would anybody else, Hey, I haven't heard from you. Everything all right? How you doing? How's the family? How's good? You develop relationships with these people. I don't look at a customer. I mean, it may start that way, but when you work with someone for years, month at day in day out, it's like you get to know them a little bit, and not every relationship is rosy, but I don't think any of us are bad people. I don't think anybody wakes up in the morning saying, "I'm gonna be a bad guy," and I know I definitely don't. And if I do a deal with someone and, maybe I've had this happens to me, it's happened to me in the past a few times. I financed the development. You establish a rapport, a friendship, a liking to a customer. You tell them, hey, listen, we got it done. You're welcome to come back anytime. And they just don't, because maybe they got scared of the process. They were like, too much of a headache. I don't want to deal with it. I still call here and there and say, hey, how you doing? How's everything? How's the family? Everybody all right? Just checking in. Pass your name on my Rolodex. I still have a Rolodex. I learned that from one of my original mentors. He was known to have the golden Rolodex. So I just,
Is there any piece of advice that you got early on in your career that you still hold with you now?
yes. And I think I just touched on it. The work is not hard. It's the managing and the dealing with the people and the personalities. That's the challenge. The work itself is not hard. It's a process, and at this point, a pretty well established process. Construction and building methods and techniques, it's there. It's just the guy who's doing the work. Sometimes he's in a bad mood, sometimes he's in a good mood. Same thing in banking. You show up and you're happy, but that doesn't mean the next guy's happy. If they're having a bad day and you have to read it, hey, I need to process this requisition. How are you? I'm okay. It's on cue. I'll get it done. All right. Thank you. Appreciate you. And then maybe you go buy some donuts. It's like, hey, I brought donuts for the department. Like, hey guys, please enjoy. Thank you, by the way, everybody goes through something. So yeah, I follow up. I try to stay in touch with people as best as I can. I wish I could do a better job at it. It does. The days go by fast. Like, you wake up, I want to get 10 things done, and maybe you get through 3. And then you wanted to call a whole bunch of people that for one reason or another you didn't.
How does your day-to-day look like?
Uh, well, wake up, right?
Yeah.
That's the most important part. Um, get to the office. So our office is in the Bronx. We have parking. That's a relief. Uh, and then essentially it's a continuation of just larger goals. But half the day is speaking with executive management and, ascertaining what our larger targets are on a month, 2-month basis. I really don't like to get too far out because there's just too much. I like to say, okay, what do we got to do this week? What do we got to do this month and next month? And that's it. I'm working on that. And I know that these intervals are working towards a much larger goal. Then the other side of it is talking to the staff, making sure that everybody is, you know, hey, what's happening with you? How are you managing the requisitions? Are there anything that we need to worry about? Anything you need us to look into? Any phone calls we need to make? Okay, great. Application intake. Hey, is this person submitting everything that they're supposed to submit? Okay, great. Um, the reporting. Hey, how are you doing? Do you have all the data points you need? Are we processing what we need to process with the other departments? And just general administrative stuff. And then on top of that, you have just the pop-ups. Either someone shows up, you get those phone calls that you didn't expect that tie you up for an hour, half an hour, whatever it is. Um, at some point, you want to grab lunch, and that's the day.
And you're a commercial lending partner for so many mortgage brokers like myself, and we have had nothing but positive experiences.
Thank you.
So what do you look for in a submission package? What do you look for right away that tells you a deal is something that you do?
Simplicity. Just pure simplicity. I don't need those decks that are just filled with fluff where I need to get to page 8 to look at what I need to look at. Honestly, that back of the envelope analysis works just fine with us. Give us our rents, give us our expense projections, give us our comps, give us the bio. And it doesn't have to be the most extensive bio. Just we know, I don't know, maybe that's a blessing, but we know who's who and who's done what. We don't need the fluff the I guess maybe it's just because I get so many deals that I don't have time for the fluff. Like, just what's the address? What are the rents that we're projecting? What's my cost to build? Give me the budget. Who's the guy behind it? The developer, the sponsor, or organization? Because there's also very strong female developers out there. We need more, actually. I find the that demographic, they're laser focused. Laser focused. Um, and yeah, that's what we look for.
And kind of transitioning to the younger generation, what do you look for in, well, what advice would you have for young bankers getting into the construction world where, you're dealing with very sophisticated people that know what they want, that know exactly the
Okay,
structure?
okay. So for the younger banker, I consider myself a bit blessed to the extent that my original mentors, the guys that taught me, they didn't have the internet like that. They were pre-internet. So they literally, no, I kid you not. Like, we're laughing about this, but it's the truth. Life did exist before the internet. I want to tell the young banker, stop hiding behind the screen. All right. Your comps, just because it's on paper on an Excel spreadsheet doesn't necessarily make it real. You literally got to go pound the pavement. I do that. If I get a loan request and I'm not sure about the area, or I don't really know what's going on, or I feel out of touch, throw on my sneakers, throw on some jeans, a t-shirt, go have lunch. Like on a random Saturday, a random Sunday. Go have dinner on a random night that I'm not so bogged down. And I got to go feel it. I did some so a few years back, pre-pandemic, there was made, and it's still a lot of noise. Flatbush Avenue, around Kings Highway by Brooklyn College, that area. I remember that area when I was a little kid, and it was working class. It wasn't the easiest place to be around. And all of a sudden, I'm getting loan request after loan request after loan request in this area because they had great zoning. They still have great zoning, and I'm seeing the rent projections, and I'm like, I don't know. I haven't been out there in years, so let me just drive out and head there at night. And I'm starting to see the new construction, and I'm looking to see if there's actually people there. Are the lights on? Uh, and I'm seeing it, and I'm walking around Flatbush, and I'm seeing I'll use the word gentrification. I'm seeing it. You know, unless I did that, I wouldn't have known. You know, and this was 2018, 2019, 2018 that I'm hearing all this, and I'm starting to catch wind of it. Developers I respected, I'm like, hey, you sure these rents are real out there? Like, it's real. I'm like, okay. I still didn't believe it. I had to go out there. And yeah, that happened. And I do that. I do that. So that's something that I would say to the young banker. Um, get out of the cubicle, get out of the office.
Put
Go.
the boots on the ground.
Put the boots on the ground. A good way to find out what's happening is the restaurants, because the restaurants cater to the local demographic. If you start seeing and you go and you ask the manager or whoever, the waitress, how many times have you guys changed the menu over here? What type of, oh, forget it. The prices are going through the roof over here, and we're changing the menu. We're going more organic, so that kind of gives you an indication something's happening.
And then on a more personal level, what keeps you motivated?
This sounds cheesy. The hustle. It's the hustle, man. I don't. I. You just meet so many good people, and I geek out with the buildings. I'm not a developer on any level. Um, but there's not a borough, there's not a neighborhood I haven't touched. I think even my mom gets annoyed because there's times that I'll pick her up, and let's say we're driving through the city, and I'll detour. Wait, I did a couple buildings. Ma, you gotta check them out. They're really nice. And that's it. That's all it is. Is the fact that I know New York City is going to be a better place the day I'm gone, and I contributed a little bit to that. That's what keeps me going. That's all it is. It's weird, but
So this isn't even a job to you; it's a life career path. It's
so at this point, yeah. I've never looked at it, maybe in the beginning, as a job, but I just had too much fun with it. And in having that fun, it's not only did I have fun, but I also felt I feel like I'm just talented in it. Uh, it's like a gut feeling when I do these things. I've had buildings come up, I've had projects come up. I don't even have to think about it. It's like I already know how many units, what block, this neighborhood, this price point. Like I don't need an appraisal at this point. Like it's like that's a good. Of course you need an appraisal because you got to go through the process. You have to document the process. But I'll give you an instance. There's a section in Brooklyn, um, and I get real specific, but there's a section in Brooklyn where I got into a blatant. I just did not agree with the appraisal. The appraisal was rents per square foot. He was projecting out at best like 50. I was like, you can. The area is changing. I'm telling you. I see the restaurants coming in. I see the demographic. It's spillover from like Williamsburg into. So you see how it happened. Like from Williamsburg to Bushwick to now Cypress Hills is starting to spill into Cypress Hills. And that's just logical, right? If I want to live in Williamsburg, we can't really pay Williamsburg price points. Bushwick. Now Bushwick is up there, and you still want to do Brooklyn. Let me split that, right? Because you could go to Ridgewood. Ridgewood's not the cheapest, but it's Queens, and some people feel that I just need to be in Brooklyn. I get that. It's a thing. So they choose different submarkets. And in one instance, I got into disagreement with the appraisal. The appraiser, he took a firm stance. Nothing I can do about it. I was stuck. I got my hands chopped off. The appraisal's the appraisal. It's just you got to deal with it. I tell the borrower, listen, our loan amount, it's gonna be this. It's not what he wanted. Again, it's not even what I thought it should be. But again, can't do nothing about it. Um, we went with it, and he took the loan, and we got it done, and we stabilized. We hit the numbers that we were projecting. I didn't hit the numbers that the developer was saying, but I felt validated in that rent roll. And not to hurt anybody and not to, thumb anyone, I took the rent roll and I very politely sent it back to the appraiser. And I said, listen, I know you remember we had this conversation, and just save it for your database because there will be more development out here. And it's important for you to have this.
did he take that lightly?
He wasn't going to say nothing bad. Oh, okay. Again, you're on my team, man. You're on my team. Like, I need us to be accurate.
Yeah.
So one time, and it was a developer, great guy. He turns around, he tells me, so I spun it. I said, congratulations, sir. You really exceeded the expectations. You beat the projections by 10%. And he looked at me, he said, no, Doug, you guys shortchanged me. I looked at him, I was like, no, we didn't. But I get where he was coming from. Sometimes the developer, because they're there, they know what's going on, and they know what's going on better than the comps can quantify. There's a lag between comps and what's happening on the street. The developer's real time. The comps take time to gather and to establish. And somewhere in the middle is the right loan amount. Somewhere in the middle is the right loan amount. My job is to ensure it's not aggression. I'm not trying to be the most aggressive lender, because that's a recipe to, crash. Our function, our role is to be the most precise. and fair and reasonable. It's easy to be conservative. That's easy. Oh, these are the rents, and it's been historically proven. That's easy. That's easy. In certain instances, we have to capture the the time, the times, like you know, and thankfully, New York City's benefited from a super strong rental market almost across the board. Certain submarkets have stood a little flat. Uh, I guess I can say it. The neighborhood I grew up in, that their rents didn't really move. And that was in Queens by City Field. That Nothing happened over there. Still a great place to rent, steady cash flow, but you don't go aggressive on your projections.
And you mentioned that you told that borrower that the loan got cut, right? So how do you go about delivering bad news to borrowers that they don't want to hear?
Just like that.
Just
You
tell them
just
how it
tell
is.
them, it's not how it is, it's what it is, and you do so human to human, human to human. Like, people are amenable to even bad news as long as they understand your position and where you're coming from. So, it, gentlemen, I am a bank, federally regulated. I have a formula. I am bound to my appraisal. This is an approved consultant. And yeah, it's easy for them to say, "Oh, just order a new appraisal." It doesn't work that way. Doesn't work that way. You just don't start replacing to get to something that you want me to get to. That's again another recipe to get. No, this is what it is. This is what we can do. So I guess to mitigate a lot of that, it's very, very important that you're in tune with your numbers up front. So you can set expectations up front. We're not the type of institution, and I'm definitely not the type of lender that's going to take your good faith deposit and maybe it works or maybe it doesn't. I don't do that. I've seen bankers do that. It actually is one of my biggest pet peeves. Um, they'll take a good faith deposit. They're very whimsical about it. Oh, it's only, a few thousand, it's tens of thousands. Let me start there. And then secondly, even if it's 10 grand, and I get it, this potential borrower has an infinite balance sheet. Who likes burning that kind of deposit? Nobody.
Nobody.
Nobody. I don't care who you are or how much you got. I take that seriously. And even before I take that, we have to sit down, we have to sharpen our pencils, we have to reasonably come out with what we think is going to be a real loan amount with real rents. Does this work? Yes. If we're in this ballpark, it works. Then we go to appraisal. And we're confident that we're going to this is where we're at. The only thing that really messes up a pro forma for us is if we're off on the tax calculation. But in terms of the actual rent projections, we're pretty spot on. I mean, we're building everywhere. We have the data points for everywhere. Building expenses, we revisit those every year, so we stay in line with those. And taxes could be a swing sometimes.
So you always know what you're walking into.
For the most part, we take it seriously before we start spending someone else's hard-earned funds.
Yeah.
I've seen bankers say, "Oh, let's order a report. Oh, it didn't work. Okay, it's non-refundable."
Yeah.
Like, what is that?
And then to end on a lighter note, if you weren't a banker, what would you be doing?
I mean, I've been so I grew up in restaurants, and I wanted to go to culinary school. Just parents said no. Parents said no.
So you'd be a chef.
Oh, yeah, probably like a foodie, restaurateur type of thing. That's my gym.
Me too.
Yeah, yeah.
Awesome. Doug, thank you so much for taking the
Thank you.
time to be with
Thank
us.
you. Thank you.